Hello, welcome to ProTraderStrategies.com. This is a tutorial on options and options basics. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented on everything from geopolitical to economic and market analysis. Some of those online medias referred to me as the Wolfman. I've been trading my own money for well over 20 years now. And I'm not here to tell you I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, manage your own risk. Like I said, I've traded most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products. This is an educational company, and we're here so that you don't have to rely on anyone else to take control of your finances. I'm going to teach you rules to implement trading strategies into your own account so that you can manage your own portfolios. This option series is all about the different strategies and options that you can implement into your portfolios. This particular options part 9 is going to be a little bit about the nuances of how pricing is affected by dividends, splits, and things of that nature. Further on in this series, I'm going to be going into how the volatility or vega and how the theta are affecting your different options strikes and things of that nature. This is going to be specifically about how dividends and splits will affect your prices and why one would want to buy call options. Many of the other ones have been around why you would want to sell options. This one in particular is going to be why you would want to buy them. Having said that, I have a little bit of housekeeping to go over. This disclaimer here talks about that Pro Trading Strategies is an educational company. We're here to teach you how to swim, not to swim for you. At the end of the day, I'm going to teach you strategies, but you need to do your own homework. And please remember, past performance is not indicative of future results. This particular also goes on to kind of really say that I don't know what's in your portfolio. I don't know if you've watched this 2 years down the road. I don't know if you've watched this 2 days down the road. If I talk about a specific strategy, you can't just go out and put that into your portfolio without doing your own due diligence. This disclaimer goes on to say that everything we talk about in these tutorials are going to be simulated performance, being because I can't put out a specific trade recommendation. I can't tell you that this would be a good strategy to implement because I don't, again, know when you watch this. Okay, when would we buy options? The only time you want to buy options is when there's very low volatility, or the IVR, which is the implied volatility rank, is very low, which is the IVR is basically an implied volatility upon its implied volatility, which may seem a little bit confusing, but some stocks are very volatile and some are not. So if you have low volatility, maybe that stock always has low volatility, but it's high in relation to itself. So that's really what I look at as low volatility. You have to have low volatility within itself. And you may want to own this stock. You think, say for instance, a stock is going to go from 5 to 10 or 20 or more, and you may want to own it, but you're not completely sure, so you want that limited risk. So those are the only times you would really want to buy an option. When there's very low volatility, you would want to own it, or you want the limited risk. For instance, this stock may go way down in value after earnings, and you don't want to own it. You want to have that limited risk, so you don't go out and buy that stock. So when would we want to exercise these calls? Well, there's a dividend. But you got to remember that that dividend better be very big, because occasionally a stock will pay big dividends, and exercising the call option will capture that dividend, but it'll be worthwhile. Remember, options traders are very savvy in that they are going to likely price in those dividends coming up. But if there's a special dividend that somebody didn't know about, that might not necessarily be priced in right away. And you may want to take that stock on so that you can receive that dividend. You may just want to own it. You may love Tesla and think that these new products that Tesla is coming out with is going to really make that stock take off in value. So you would buy the call options in the case that that stock really runs up. And all of a sudden, this option has gone deep in the money, meaning this stock has really rallied and it's just not liquid down there anymore. People aren't really trading that. They're not watching it. So the bid-ask spread might be very wide at that particular strike. And in order for you to sell it, you'd really be selling it well below the price of the intrinsic value plus commissions that you would incur. So the commissions you would incur if you exercise this, the brokerage is going to charge a fee and you're going to have to add all that into the structure. So if you had to sell it well below the intrinsic value and the commissions didn't take up too much of that, then you could possibly look at exercising that option and then immediately cover it in the open market. Why wouldn't you want to exercise the call? Because the option's intrinsic value is going to be equal to what you would have to sell it for and then get out of it and go to the market. You also wouldn't have the margin necessarily in your account to buy that stock outright. Say, for instance, you're trading in a small account that has maybe $10,000. You can trade Tesla options, but you wouldn't necessarily be able to exercise those calls because you don't have enough margin in your account. And if you didn't want to take the risk any further, this stock may have rallied up, but you know, when stocks have big moves to the upside, they do have a tendency to pull back. So it might just behoove you to sell that options contract and not necessarily exercise it. Going to fees and interest, the fees of the brokerage that you're going to have to pay to exercise that call and then get out of it on the open market are going to eat into your profit margin. The situation with Tesla that I was talking about, that you may not have the money in your account to cover the cost of actually purchasing all those shares of Tesla, well, that broker is going to charge you interest on the money that you borrow from him to purchase those stocks. The effect of dividends on options. Well, call sellers are assumed to receive those dividends, so that's going to be priced into those options. Thus, the options premiums are going to be discounted. The discount on the calls, though, isn't going to be as big as the discount or the extra premium received for the puts, because the puts are expected to drop. Everybody knows they're going to drop. So those premiums are going to get pumped up whenever there's dividends coming in. So keep that in mind when you're trading options, because if you were to buy a call right around a dividend, you're going to lose a little bit of money there. Stock split effects on options. We can easily do the math. The math on these is pretty simple, so we can really bang these out. We all know that stock options have 100 shares of the underlying for each contract one would own or possess. And let's say, for instance, the strike of 60 and the premium around that strike is $3. It doesn't matter if it's in the money or out of the money. We're just saying the premium is $3. There's a 2-for-1 split. Okay? So that's going to take that $60 strike and it's going to go to $30. Just like a $60 stock on a 2-for-1 split would go to $30. But now we're going to get 2 options contracts instead of 1. So if we had 10 option contracts, we're going to have 20. If we had 1 option contract, we're going to have 2. But the strike is going to be $30. And that premium is also going to go down by that same ratio and will now be worth $1.50. And you can reverse out the math. If you have a $30 strike times 2 options, that's 60. And if you have a $1.50 premium times 2, that's 3. This is where it's going to get a little bit more confusing for some people. Now we have a 3 for 2 stock split. We have the same strike, we have the same premium, and we always have the same 100 shares of underlying going into this split. But with a 3 for 2 split, they can't give you really fractional shares. So the clearing organization, the CBOE for example, will make that 100 share underlying be 150 shares. And if you take the 3 for 2 split and create a ratio with that, you come out 3 divided by 2 is 1.5. So that's going to be the ratio we use. So if we take the strike of 60 and divide that by 1.5, it gives us a strike price of 40. And if we divide the premium by 1.5, that gives our new premium as $2. And again, you can reverse that math out to check your math. If you multiply $40 times 1.5, it gives you $60. And if you multiply $2 times 1.5, our ratio, it gives you $3. So that's the only place it gets a little confusing. You just have to take the 3 for 2 split, divide 3 by 2, it gives you 1.5. Just like in the previous example, a 2 for 1 split, 2 divided by 1 is 0.5. So you ended up multiplying those or having those in the previous example. Now we're going to go on the reverse split. And you just need to do the math. The stock options have 100 shares of the underlying for each contract owned or possessing. And the strike of $6 a share. The person owns 2 calls. So for every 2 calls, you would only have 1 now. And instead of the strike being $6, it is now doubled to 12. So it goes the other way. Before we were reducing the size, this is going to increase the size. And in our example, say for instance we had a $1 premium, it would now be a $2 premium associated to that. Most likely it would probably be closer to maybe a 50-cent premium. It would now be a $1 premium, would be another example. So you just have to double what that premium would be as well. Well, that's all I've got for you today. Thank you guys all for watching this online tutorial. In later videos, like I said, I'm going to be drilling down on the pricing, dealing with the calls and the puts and how Vega and Theta will affect those. We're doing this just so you can take control of your finances. And you can go on Pro Trader Strategies and look for a broker. You can kind of look around, find out which one's right for you. I particularly use TD Ameritrade. It's on there. We also have Ninja Trader and several other brokers that you can use, having the charting systems and stuff like that. If you're not savvy with charting, we also have the PET D. You can look at that on ProTraderStrategies.com. I want to just thank you guys all for watching, and please comment at the bottom of these so that in future online tutorials I can really drill down on what you guys are looking for, what you guys want to hear, what you guys need to have in your wheelhouse in order to start trading your own accounts. So please comment or like at the bottom here, and keep your eye out for future webinars. You can find those on the website ProTraderStrategies.com. I'm going to be doing a couple of webinars coming up here very shortly, so check those out, sign up, and I hope to see you there. If you can't take that, take it easy.
Bulls can take control and push this up, or the bears take control and push this down to the 1400 level. That's going to be setting up for this week. All right, if you can't take that, take it easy.